Thanks, Tom. I'm Jeff Tjornehoj, head of Lipper Americas Research, and I'm going to cover the third quarter fixed income funds and fund market. I'm going to pick up where Tom left off. Remember where he said, don't fight the Fed? This is probably where we had some of the most interesting activity in the third quarter. Two very high-profile central bankers made pronouncements in the third quarter that, in my view, changed the dynamics for a while anyway. On the left here is Mario Draghi. He's the former head of the Central Bank of Italy and now the head of the ECB. And on near the end of July, he came out with a statement saying that the European Central Bank would do whatever it takes to preserve the European Union. And at that point, up to that point, we had seen the U.S. Treasury market just get stronger and stronger and stronger as concerns mounted every day over what was going on in Europe. He came out with that statement, and immediately there was a bit of a setback for the Treasury market. People started to take a bit more risk, I think is what the bottom line here is. So we saw, for the most part, his statement about whatever it takes to mean that this new program called the outright monetary transactions that the ECB will undertake means that they'll buy short-term maturities, usually 1 to 3 year paper issued by sovereigns, as long as those recipients apply for rescue funds. So basically, somebody has to commit to a bailout before they get any help. They don't. I think this is the ECB's way of saying they're not just going to make loans without some additional, without a stick behind that carrot as well. So in order to get the rescue funds, there's got to be some austerity programs in place. So a bit of discipline for governments willing to do this. Spain had indicated up to this point that it was willing to talk about some austerity plans and rescue. But then after this, yields on Spanish debt came down, and then Spain seemed to be shrugging off its concerns for a while. That may change. The next event was later on, about September 13th. This is when Bernanke said that they needed to see ongoing sustained improvement in the labor market before the Fed would let off the gas pedal. So out of this, we got a $40 billion a month commitment by the Fed to purchase mortgages, and this is, an ongoing plan. There's no sunset provision here. It's indefinite, in other words. They also extended the Operation Twist program. This means that there is about $85 billion a month in Fed activity in the fixed income market. So a big buyer came into town, and you could see at this point that the yields on the Treasury, which had been working their way up after Draghi's pronouncement, started to work their way back down. I really thought that those two events spoke volumes about the activity in the quarter. The next thing we're going to look at is Treasury funds and Treasury-related categories. How did they do? I highlighted some of them here. You get to see everybody else, but you can see at the top here, TIPS funds had an excellent quarter. As a group, they were up about 2.12%. That's a great quarter. Short U.S. Treasury funds, rather quiet, and then the rest of them, general U.S. Treasury, general U.S. government, were some of the poorer performers, although still in the black for the quarter, but really not so hot. Then at the bottom, another Treasury-related one that I'll call general muni debt. Munis had a very good month. They were up, in this chart, nearly 3% on the quarter. We saw issuance in munis up in August. This was mostly due to refundings, but there's a strong appetite for muni paper right now. Interestingly enough, over the quarter, Barron's profiled some states and talked about underfunded pensions and how that could really wreak havoc in future credits and ratings on these states. The ones that they pointed a finger at were Illinois, Hawaii, New Jersey, Connecticut, and Puerto Rico. Much of this paper often shows up in muni portfolios, so something to keep an eye on. But I'd say with the whole, if the risk-off mentality really starts to get going, I could see high-yield munis hurt the most on that. They've had obviously a great quarter here, but looking ahead, I think people might look to other areas for yield and may not give a strong look at high-yield muni going forward. So here is a chart of TIPS yields. As you can see, this is all below zero. So this has not been a play on inflation. In fact, we initially saw, after Bernanke's announcement, some inflation worries starting to perk up a little bit. Looking at the market between 5 years, the 5-year spread, 5-year forward, investors are really showing a concern for inflation a couple of years out. Over the next year, 2 years, not much of a concern. There's a bit of a concern over the 2 to 5 year period out, that when we might start to see some early signs of inflation. Initially, the break-even rate between TIPS and their regular Treasury peers increased. They settled back down, so they went to about 2.7%, which was the highest that the break-even rate had been since May of 2006, and then quickly settled back to about 2.40%. So I'll show some more data on current yields on sovereign benchmarks and the latest inflation data, but suffice to say at this point, inflation's not a strong concern in the TIPS market. Treasuries over the quarter, this mimics that first slide where we looked at Draghi and Bernanke. You can see in this the orange bar in the middle how that line kind of shifted down. Draghi comes out, it goes back up, and then after Bernanke speaks, it trends back down. We didn't see a whole lot of movement in the yield curve this quarter. Here's the way we looked. The red line is at the end of September. The light orange line, barely, mostly hidden, I would say, was end of the second quarter. We saw a little bit of activity in that 2 to 5 year period. Overall, though, fairly flat activity on the Treasury yield curve looking from quarter to quarter. The next group we're going to take a look at is corporate debt funds. I highlighted high yield, BBB, and A-rated funds here. They performed in that order, with high yield doing quite well. High yield funds were up about 4.3% on the quarter, while BBB funds were up about 3.6%, and single A-rated funds about 2.6%. So quite a bit of difference here. What we saw as far as their benchmarks go, and these are the B of A Merrill Lynch indexes, is initially those BBBs were doing quite well, and high yield was having a tough time finding any traction. Again, Draghi comes out near the mid-July. That changes everything for high yield. High yield starts to come back up. Worries about sovereign debt overseas, which had been in the back of everyone's mind at home, were lifted, and that helped the high yield market quite again. Again, the risk-on mentality seemed to help them quite a bit. High yield yields right now are very, very low. They're only about 6.5%. Interestingly enough, the spreads between high yield and equivalent treasuries are near their long-term average. I mean, this has everything to do with treasury yields being so very, very low right now. So kind of an odd situation for high yield investors. They're not getting paid a lot to take risk, but relative to treasuries, it's a fair trade. So I think this is going to be, I don't know if we're quite at an inflection point as far as attitudes about high yield. I could certainly understand, though, if high yield investors had a little sticker shock saying, we're making just a few points over inflation, yet we still have a fairly significant risk as far as the credit conditions go relative to something like a treasury. So we could see a bit of volatility in the market, I think, in the quarter ahead. As you can see on the bottom line here, AAAs really didn't, they underperformed relative to everybody else. Again, no no blow-ups in that market, so that it was kind of business as usual, treading water in the quarter. Next group to take a look at is world income funds, and here all the attention was on emerging market debt. They were the quarter's best performing group. They were up about 6.5%, which is an amazing quarter for anybody, let alone a fixed income group. International income also did quite well. They were up about 4.5%. Tom alluded to some of the reasons why, and you can see it under the currency funds group right here. The U.S. dollar sold off versus major currencies. This is a boon for currency funds, obviously, and then it's an added boost for ex-U.S. strategies such as emerging market debt and international income funds. In fact, the next group here compares the 10-year government index of the U.S. and as the blue line, and everybody else in the Bank of America Merrill Lynch Global Government Index. They were very steady this quarter, so not only did we have a bit of a risk on helping them, but with the U.S. dollar softening at the same time, it was a nice steady quarter outside the U.S., at least in dollar terms. So for U.S. investors, being outside was definitely a better place to go. We also saw the corporate issuance, as an aside here, for emerging market debt. By the third quarter, we're already at an annual record. So this is going to be quite a spectacular year for corporate debt issuance in the emerging market space. All systems are go in that market. Here's the slide I mentioned before. This compares benchmark yields and the local inflation. At the very top here, Greece, their benchmark yield is at the end of September close to 23%. But this speaks very little to the inflation in Greece, which is less than 1%. I think it's about 0.9% on an annual basis. The latest data show. You could look at the next group underneath. You have Brazil and India, where inflation is substantially higher, just as well in Turkey, Russia, Hungary. So in a lot of these emerging markets, a good portion of that yield is just simply keeping up with inflation. In Turkey, you're losing money. Inflation is outpacing the benchmark. Then we look down at the bottom. There's a few other interesting situations. Japan, Switzerland, both are showing some deflationary signals. Switzerland, of course, that's significantly due to intervention on the franc, but their benchmark yields are very low, just like Japan, just like Germany, United States. So some of the developed first world countries outside of Europe have very low yields right now. And then in certain other markets, especially in emerging markets, there's a lot of inflation going on. So something to consider when you're looking at returns there. My concerns looking ahead is certainly whether and to how well in the short run European leaders like Mario Draghi can keep their activities aligned with market expectations. I think the market right now is expecting things to get better slowly. We don't expect a silver bullet anytime soon, but this nice little carrot and stick approach seems to be helping matters a bit. There's certainly some unrest in the nations that are preoccupied with their austerity programs. Things could be tough for the citizenry there, but for the bond market, that's just the price to pay. Tom mentioned housing. I brought this chart in. This is the Case-Shiller Home Price Index. It says to me that at least in the U.S. there is a floor under housing. That's great. We're not going down. We haven't been going down for a couple of years, at least on a benchmark-wide situation. But without that wealth effect, without rising home values, in my mind, this kind of hurts that wealth effect where we get people more involved in the market because they feel that their largest asset is appreciating, and for most people that is their home. So without that sort of psychological lift, I have concerns that equities are going to find any footing going forward. I think we're still in that very range-bound market where 13.5, 13.6 seems to be near that upper limit on the Dow. and then anything can happen to the downside, and people are willing to dump equities at a moment's notice in order to avoid the hit. So not a whole lot of momentum out there for equities. I think it's going to be a good time to remain in bonds, certainly in the quarter ahead, and then we'll see what that brings us here on out. So thanks for your time. I'll turn it over to Matt now.